Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. Hello, in today's video we'll be taking a look at the Monday, October 20th, 2025 trading session for the CBOE SPX index. We're going to be utilizing the day trading GPS SPX Daily Key Levels indicator, specifically the newest version of the indicator, the V2.0 version, which was just released a few weeks ago. Okay, so some of you may already be familiar from watching our other videos how this indicator works, but for those that are new to this channel, I will run through how this indicator works before we get into the rest of the video for the rest of the session. Alright, so the way this indicator works is it works on two different trading symbols for SPX. The first symbol it works on is what we have on the chart right now, which is the CBOE SPX index. So on TradingView, this is going to be your SPX symbol, and it's going to be the CBOE exchange. So this is the official CBOE SPX index on TradingView. This indicator also works on a second symbol, which is a Forex CFD symbol, and that would be the SPX 500 symbol on TradingView under the 8-cap exchange. And I'll get into why it works on two different symbols here in just a second. So first of all, how it works on the SPX CBOE index. So at 9:30 a.m. the SPX CBOE index opens, and on the first tick at 9:30 you will get the levels updated on your chart as you see on the chart right now. The main, most important level for the trading session will be the indicator's SPX Bull Bear KPL, which stands for Key Price Level, which for today's session was 66.9314. So this indicator analyzes recent days price action in SPX, as well as volatility and current market dynamics, and it also analyzes the overnight and pre-market action in the ES E-mini futures to analyze and come up with the most important bull bear key price level for today's session, as well as the other main R and S levels. The main levels above the bull bear KPL are R1 through R6 by default, and the main levels below the bull bear KPL are S1 through S6 by default. The meaning of these levels are primarily at the beginning of the session, they are take profit levels for bullish or bearish trades that are derived and triggered from the bull bear key price level. So for example, the main R levels above are going to be your take profit levels for bullish trades that are derived and triggered off bullish signals from the bull bear KPL level, and your S1 and below levels are going to be take profit levels for bearish trades that for bearish entry signals derived and triggered from the bull bear KPL level. You can also take bullish and bearish trades off of the R levels and S levels, so it's not just confined just to taking trades off the bull bear KPL level. We do have another video. Normally we also append that video to, if you look at our recent 7, 8, or 9 most recent videos, we typically will append that video to the main video. Today's we're not going to do that. We're simply going to let you look in the video description for other videos that will describe other aspects of this indicator, one of which will be a video on how to take bullish and bearish trades off of the other main R and S levels as price action continues throughout the session and those levels become more relevant for taking either bullish or bearish trades. So if you look in the video description, you'll see a link to that video, and you will also see links to other videos that cover other aspects of other things to do with this indicator. So we're going to try to make this video a little shorter than normal, and just leave it up to you to view the other videos that cover other sections of this indicator. Okay, so let me briefly, before we get into the other levels here, and we'll come back to this chart, we're going to pause and go to the SPX 500 8-cap chart and tell you about the relevance of why the indicator works on that second symbol as well. Okay, so this is the SPX 500 symbol on TradingView on the 8-cap exchange. So this is a Forex CFD that trades in the pre-market, and the reason for this indicator working on this particular level is twofold. One of which is for those that are not trading SPX index options on the CBOE SPX index. Most of the people that use this indicator do use it for that purpose. However, there are people that do use it for trading through a Forex broker, or they're taking a trading challenge through FTMO or one of the other Forex brokers that offers funding trading challenges, in which if you pass a challenge, you can get a you can qualify for a funded account with them to trade using their funds for Forex. So for those individuals that either have their own Forex account and prefer to trade SPX 500 through Forex, through a Forex CFD instead of index options, then you can utilize this indicator for that as well. The second reason why we have it work on this second symbol is that this gives you the availability of being able to see the levels for the CBOE SPX index 30 minutes before it opens at 9:30 a.m. Eastern Time. So the way that TradingView PineScript coding works is that even if your indicator already knows what the levels are going to be for today's session before the symbol opens for trading, and while the symbol is still closed for trading, which CBOE SPX index is closed at 9 a.m. because it does not trade in the pre-market. However, this indicator does know at 9 a.m. what the levels are going to be for the session. But the way TradingView PineScript works is that if you have an indicator on the symbol where that market is closed, even if the indicator already knows the levels that it's going to be plotting once it opens, it cannot show them due to PineScript limitations until that symbol actually opens for trading. So if you have a second chart open on the SPX 500 8-cap chart, then if you wish to see the levels for CBOE SPX 30 minutes prior to the 9:30 open, then we have this second table here, which will give you the levels that you will see at 9:30 when your indicator's on the CBOE SPX chart. So this way, this can give those people who like to see the levels early and maybe do a little planning out of perhaps what they may be looking at to do during the session. They can get a jump on things 30 minutes early if that is important to them. So you can have this symbol, you can have this indicator, on open on two different charts, one for SPX 500 8-cap and the other for CBOE SPX. This other table here is the SPX 500 8-cap CFD levels, which you also see over here. In this particular chart, we don't have the midpoints and all the other levels turned on, but as you can see here, we do have 9 o'clock. That's when you would get the levels on this particular chart, and you would be able to see these early for the CBOE SPX. All right, well now we'll go back to the other chart. Okay, so now we're back on the CBOE SPX chart. We'll run through the other levels here before we get into the session. All right, so as you can see here, there is a table here with, oh, by the way, this is the same table that you saw, the second table on the other chart, and then these bull bear key price level and main R and S levels are the same ones here that you saw on the second table on the SPX 500 chart. It's just these come out at the first tick at 9:30 while on SPX CBOE. Okay, so the levels over here, this represents the CBOE SPX pre-market high. So even though SPX CBOE does not trade in the pre-market, this indicator is able to give you what the pre-market high is based on its analysis of ES futures. So here we have the XPX adjusted pre-market high, which is going to be 67.0148 for today. Here's the pre-market low, 66.7498. This represents the actual SPX RTH session high. Since we're on Monday, this would be the previous day, which would be Friday. So this represents yesterday's daily RTH session high, which in this case, since it's Monday, would be Friday. If this was Tuesday, then this would be Monday's RTH session high, etc. YDL represents the previous day's RTH session low, and YDC represents SPX RTH session previous day close. Now these levels can also be very important levels to keep in mind, especially when they are in confluence with other levels on the chart. They can also act as support and resistance levels as well, because they are important levels from the previous day session as far as these three levels here. And of course the pre-market high and pre-market low are levels that are necessary as well as far as breakouts or breakdowns. Now as you can see here, we do have the table, but these are also represented here with line labels. So if you don't want to have this table on your chart because it takes up space and you'd rather not have it on the chart, you do have the line labels here with the prices as well. So in the user control panel, you can go ahead and uncheck that if you don't want to see it on your chart. And that is also one of the video links that you'll see in the description is a link to the full features and setup for this indicator, which is a whole nother video itself, which we're not going to go into all those features and inputs today. But if you are interested in looking at that, then you can simply go to that video that is in the description of this video, and you can take a look at all the different inputs and different features of this indicator through that particular video. Also, this table here is also optional. You can turn it off if you don't wish to have it on, because you do also have the line labels here. Okay, so the other levels you see here are midpoint levels. By default, some of the midpoint levels are not turned on by default, and that is by design, because usually at the beginning of the session, the level that's primarily in play at the beginning of, say, 90 to 95% of the sessions is going to be the bull bear key price level. So by default, the default display look is going to be all of these pre-market levels and YDH levels, all of the bull bear key price level, and then all of the main R and S levels, and then the first midpoint above the bull bear KPL, the first midpoint below the bull bear KPL, and the QL above the bull bear KPL and the QL below the bull bear KPL. These other midpoint levels that you see are optional, and you can turn those on manually, or you can set them up however you would like to setting your own default settings if you prefer other ones besides the ones that we have set for the default, which that is also gone over in one of the videos that are in the video description if you'd like to look at a video on all of that. Okay, so now we're going to get into the session, and then we'll describe how these levels are utilized and what their purposes are. Specifically, these midpoint levels. The midpoint levels, again, are going to be your mid-levels between the main levels. So, for example, mid R2, R3 is the midpoint between R2 and R3. Mid R1, R2 is the midpoint between R2 and R1. Mid BBKPL R1 is the midpoint level between R1 and the bull bear KPL. BBKPL S1 is the midpoint level between the bull bear KPL and S1. Mid S1 S2 is the midpoint level between S1 and S2, and mid S2 S3 is the midpoint level between S2 and S3. And as you can see here, here are the PMH, PML, YDH, YDC, and YDL. And we did talk about previously about confluence. So these levels can come into play as far as being important on many days when there is going to be confluence between them and the other levels. Okay, so let's just get into the session here. Here is the 9:30 opening candle for today's session. As you can see, we're on a 2-minute chart. This indicator does work on time frames between 1 minute and 30 minutes. So the minimum time frame is going to be 1 minute for a chart time frame, and the maximum chart time frame is 30 minutes. If you put it on a chart time frame that is above 30 minutes, then you will get a disclaimer notice on your chart that will tell you to set it back to a chart time frame between 1 minute and 30 minutes. As you can see, we have it on a 2-minute chart time frame. The reason for that is we've found that the 2-minute chart time frame works best for this particular strategy. There are people that use this indicator for various different strategies. The strategy that we employ is simply buying calls on bullish entry signals and buying puts on bearish entry signals. Our strategy does not involve spreads or other types of combination trades such as iron condors or butterflies or one of the other myriad combination trades that you can do with options. We simply employ buying calls on bullish signals and buying puts on bearish signals. However, there are people that do use this indicator for iron condors, for butterflies, and for other types of strategies. And for those types of strategies, you might find it more useful to use it on a different time frame, such as 5-minute, 10-minute, 15-minute, or even a 30-minute, depending on what kind of strategy you're employing. We primarily put out videos based on this particular strategy. However, this particular strategy is not the only strategy that you can use this indicator for. It just happens to be the main strategy that we put out to mainly use with this indicator. So the chart time frames primarily for this type of trading with this indicator would be 1 minute to 5-minute time frames, and we have found the 2-minute to be the most productive consistent time frame for this particular strategy. You may find that a different time frame works better for you with this particular strategy, but if you look at our videos, you'll find that this is the time frame that we use on all of our videos. Okay, so we have the 9:30 a.m. candle here. So this is the opening candle. As you can see, it opened below the bull bear key price level today, but rose above the bull bear key price level, and then closed above the bull bear key price level. So this is your bullish entry signal, and this bullish entry signal is going to be off of and triggered by, derived by the bull bear KPL, because we have a cross above and close above the bull bear key price level. Now, one thing I want to point out is that there's no rule in this strategy that says that you have to take the opening trade off of the 9:30 a.m. candle. You also do not have to take trades off of the bull bear key price level. So as I mentioned earlier in the video, there is a link to another video in the video description, which is a video that goes over how to take bullish and bearish trades off of the other levels, the R levels, the main R levels, and the main S levels. So if you're more inclined to do so, you can simply wait for price action to play out a little bit in the session, however long that process is for you. You want the first 10 minutes to play out, the first 30 minutes, or the first hour, or what have you. If whatever suits your particular process best, as far as letting the market breathe a little bit, and then make either bullish or bearish trades off of whatever levels are relevant at that time in the session. So if you want to take a look at that video, you can do that. But our primary strategy does involve taking typically trades off of the bull bear key price level on the 9:30 open. However, I just want to make it clear that that is not a rule or obligation as part of the strategy that you have to take that. You can just simply wait and instead take a trade off the R1 level or the R2 level, or depending on how price action is playing out for the day, one of the S levels. So take a look at that other video in the description if you want to learn how to take trades off of the other levels and what to look for. That video also goes over the two different types of trade setups, one being the standard trade setup for bullish and bearish entries, and the other being the more conservative trade setup, which does take more confirmation, and we go over in that video that goes over how to take trades off the other levels as well. We go over those two different types of trade setups and how to recognize them. Okay, so back to this. So we have this candle that breaks above, crosses above, and closes above the bull bear key price level. This is our bullish entry signal for this particular level on the opening candle. So next is deciding, okay, we have our bullish entry signal. We're going to take the bullish trade. Now, what option do we use? What strike do we use? And are we just limited to one strike, or do we also have some alternatives that we can consider? So in this particular video today, we are going to go through the alternatives that you can consider, and we do also have a link in the description of this video, which also has another video which goes over this aspect as well. So if you'd like to see a further video on this aspect of deciding between at the money options and out of the money options, and how you go through the process of deciding what those are on the different levels, what those can be on the different levels for bullish and bearish trades, then you can look at that video. Today though, we're just going to look at the at the money and out of the money strikes from the bull bear key price level, because that is the trade that we have for today. Okay, so the standard play for this particular bullish entry signal off the bull bear KPL is going to be the closest at the money strike to the bull bear key price level price for the session. So since it's 66.93, that is going to be the 66.95 strike. For those that are not familiar with how SPX strikes work, they go in 5-point increments. So for example, 66.90, 66.85, 66.95, 6700, 6705, etc. So an at-the-money strike would be the closest strike to the bull-bear KPL. Why are we using that strike? Because we're going to use an at-the-money strike as the standard play that is closest to the level that we're taking the trade from. If instead, just to point this out, if instead we were taking a trade from a signal we got from the R1 level, then the at-the-money option we would use would be the closest strike to the R1 level price, which would be 67.15. So if we were taking a bullish trade off of the R1, it would be the 67.15 call. On a bullish trade, if it was a bearish trade, it would be the 67.15 put if we were going to use the at-the-money standard play. Okay, so we have the 66.95 call. We're waiting for the close of the candle to buy because we don't know where this candle is going to close. It's more important where it closes. This candle could have started out here, could have gone up, reversed, and then closed below. In that case, we'd be looking at a put option, not a call option. So we're waiting for the candle close. The price of this on the candle close of the 66.95 0 DTE option, was $22.40. Now we are going to take a look at the Thinkorswim charts on all these different options, so you can look at the data boxes, which will also be on 2-minute charts. There really wasn't enough room to put them here, so we're going to look at them separately after we get through with this. So $22.40 is the price on the close here. If you're not familiar with how options work, you multiply the cost of the option times 100, and that is going to be your price for one option. So if this was $20 instead of $22.40, you multiply 20 times 100, that would be 2,000. That would be your cost for one 66.95 SPX 0 DTE call option. Since it's $22.40, you multiply that times 100, the cost is going to be $2,240 for one of the 66.95 0 DTE call options. Now you can use 1 DTE options with this indicator as well. We would not recommend that you use anything over 1 DTE. We use 0 DTE. However, if you feel more comfortable using 1 DTE for whatever reason, then you can certainly look on your own time on what the various prices would have been for 1 DTE versions of each of these options as they progress throughout the session. But you have to keep in mind that this indicator updates the levels each morning, and this indicator is used primarily for day trading of options. So that means that you're going to be opening and closing the option positions in the same session. You're not going to be holding them overnight. You're not going to be holding them over days. You're going to be opening and closing them in the same session. Sometimes just minutes after you've opened them, you'll be closing them, and sometimes it may take an hour or a couple of hours. But you're not holding these options overnight. So you're going to be closing them out sometime during the same session. So the point being that using options that expire a week from now does not gain you any advantage because you're going to be closing them out. So if you feel more inclined, you can use 1 DTE So like I said, you can look at those on your own time as far as what the cost would have been, and then as they progress throughout the session, what the profit would have been. Okay, so that's the main standard play option, 66.95, but what about the stop loss? So the way you use this indicator is that your initial stop loss is going to be based on a level. How you determine that is, first of all, what level is the trade being triggered from? In this case, since it's the bull bear key price level and it's a bullish entry signal, then we have two choices for our stop loss. The standard stop loss is going to be the first midpoint level below the level you're trading from. In this case, since we're trading from the bull bear key price level, the first midpoint below is this midpoint here. Mid BBKP LS1, 66.8259. It's recommended to typically use the standard stop loss, not the tight stop loss. The tight stop loss is going to be more prone to getting stopped out. It does give you the benefit of having less money at risk since it is a tighter stop loss. However, you just have to be aware of the fact that along with that fact that there's less money at risk, it is going to be more prone to getting stopped out. That did not happen today in this particular session, but if you've seen our other videos, you'll see that there are many times where the tight stop loss is getting stopped out, whereas the standard stop loss in more cases is not. All right, so what about the tight stop loss? The tight stop loss is simply going to be the QL below the BBKPL. So QL stands for quarter level. So in the case of a bullish trade off the bull bear KPL, the standard stop loss first midpoint below, tight stop loss first quarter level below, or QL below. If instead this was a bearish trade and this had done the reverse and closed below, and we were instead looking at a put in a bearish trade, then same thing, this is the level we're trading. However, the stop loss would be reversed. Now, since this is a bearish trade and we're looking for price to go down here, our stop loss, standard stop loss, is the first midpoint level above, and whereas our tight stop loss is the first QL above. And this works the same on taking trades on other levels as well, as you'll see in the other video that we described that is in the description of this video, if you want to look at taking trades off of the other levels. Okay, so now what about out of the money strikes? What if you don't want to use an at the money strike and you prefer to look at an out of the money strike for various reasons? One reason could be the cost. It's going to be less cost, so there's less overall money at risk. However, with out of the money options, you also have to remember that price also has to move further, at least to begin with, to get the same amount of profit than you would with an at the money. So it's going to have to move further, at least to begin with, to do that, but it is going to cost less, so you'll have less money at risk. So therefore, corresponding, your stop losses correspondingly will have also less money at risk. But the other side of that is it's going to need to move further, at least at first, to get the same amount of profit that you would with an at the money. But in this indicator, so basically when you take a trade off of any level, you're going to have your standard play, which is going to be the at the money, and then you're going to have only two alternatives for out of the money. And they will all depend on what level you're trading from. And we go over all that in that video where we said that we'll go over that goes into more detail about out of the money options to consider on taking trades off of other levels. So we're not going to go into that aspect now. You can look at that video from that link in the description of this video if that's something of interest to you. Okay, so the out of the money ones that you can consider for this trade, that is a bullish trade off the bull bear KPL, are the process of determining that is as follows. It's a bullish trade, so we look above for our two out of the money options that we consider. The first out of the money option is we look to the midpoint level above and we look for the closest strike to that particular price level. So in this case, this is the first midpoint above. It's 6703.69. So the closest strike to that is going to be the 6705 call. The furthest out of the money strike that you consider is one full level away, which in this case is the R1 level, since we're looking above, since this is a bullish play. And R1 is 6714.24. So that furthest out of the money that you can consider on taking a trade from the bull bear KPL would be the 67.15 call option. All right, so in this case, the 67.05 on the close of this candle was $16.10. The furthest strike away that we could consider for this bullish trade off the BBKPL, the 67.15, was $10.80 on the close of this candle. You would use, even if you're using the out of the money options, you're still going to use the same stop losses as the at the money. So the stop loss is not going to change because the stop loss is based on the level that you're trading from. So you would still be using standard stop loss here or tight stop loss here, even if you're using the out of the money options, one of those two. All right, so as you can see here, now we're going to get into take profit. As you can see, none of these stop losses were breached on this particular session. And at 9:46, we have a hit of the R1 level. So the way this indicator works is you have to decide what type of trader that you're going to be. Are you a scalper, or are you looking to do regular trades? Now, you can do both. You could decide, okay, this trade I'm going to scalp, and other trades, maybe I'll just do a regular trade. So it doesn't have to be all or nothing for every single trade. But I'm just going to explain the difference as far as target exits and whether any stop loss adjustments you would do on scalping versus regular trades. So on scalping trades with this indicator, utilizing this particular strategy of just buying calls on bullish signals and buying puts on bearish signals. A scalp is a one level move target. So what we mean by one level move target is a one level move from the level that the trade is taken from, derived from, triggered from, however way you want to look at it. In this case, since this is a bullish trade, we're looking for one full level above the level we took the trade from, the bull bear KPL. So one full level above the R1. R1 is our target for a scalp. Now, with this particular indicator, we view scalping as 100% closeout only on scalps, meaning you're not adjusting your stop loss, because if you're going to adjust your stop loss, that means that you're looking for more profit, which means that you're really just doing, as we'll get here in a second, a regular trade. So if you're just scalping only, then you would 100% close out, whether you have one contract, 3 contracts, 5 contracts, 10 contracts, 20 contracts. You're closing them out on a scalp when it hits the target level. So at 9:46 a.m., if you were just doing scalping only, that's this candle right here, when it hits R1, you are closing out all of your contracts. So if you had a 66.95 call, the price on the close from hitting R1 here at 9:46 on that candle close is 26.80. So that is a $440 profit per option. The 67.05 price on the close is $19.18. That's $318 profit per option. Keep in mind these profits don't include any commissions that you may be paying to your broker. The 67.15 call option was $13.10. That's a $230 profit per option. So if you're scalping, you're just flat now because you've closed out all of your contracts. So if you're scalping, there was no stop loss hit, and you're out here. Now what if you're doing a regular trade? A regular trade with this indicator, you're looking for a minimum 1.5 level move for a regular trade. So that would be your minimum move required for either a 100% closeout or keeping all your contracts and adjusting the stop loss to break even, or break even plus a 10 to 15% profit buffer. Or if you have multiple contracts, scaling out 70 to 90% of those multiple contracts, scaling out meaning closing out 70 to 90% of the multiple contracts, and then adjusting your stop loss to break even, or break even plus 10 to 15% on runners that are left over. Now, adjusting your stop loss at this point, remember we started off using levels for our initial entry stop loss. However, when you start adjusting your stop loss to break even or better, then at that point you're changing to just adjusting your stop loss by price only. So break even is going to be the price that you paid for the option. Break even plus a 10 to 15% buffer is going to be what the price you paid for the option plus 10 to 15% added to that as a profit buffer. So in case price starts retracing significantly and you get stopped out, at least in that case, if you decide to add a profit buffer, at least in that case, you will have some profit on your contracts. And of course, if you had multiple contracts, then you would have more profit because you already closed out 70 to 90% of them at the target, at the full target, and you just adjusted the stop loss to break even, or break even plus the 10 to 15% profit buffer on any remaining runners. So as you can see here at 1026, this candle here, it hits the mid R1, R2 level. So that is a 1.50 level move from the bull bear KPL. The bull bear KPL is the level that the trade was taken from, derived from, triggered from. So this midpoint here is a half level move. R1 is a 1 level move. This is a 1.5 level move. So that's how you determine. If we took a trade from R1, then and let's say it was a bullish trade on R1, then R2 would be a 1 level move, and then this midpoint would be a 1.5 level move. If we were instead looking at bearish trades and we took a bearish trade off of S1, then a 1 level move on a bearish trade taken from S1 would be S2, and then a 1.5 level move would be mid S2, S3 as an example. So going back to this, when it hits this 1.5 level minimum level move target for a regular trade, then you have one of three decisions to make depending on how many contracts you have. So regardless of how many contracts you have, if you have one or you have multiple, you can either 100% close out the contracts or keep all the contracts and simply adjust the stop loss on all of them to break even, or break even plus a 10 to 15% profit buffer. And only if you have multiple contracts then are you able to scale out 70 to 90% and adjust your stop loss to break even or break even plus the profit buffer on remaining runners. So as an example, if you had 4 contracts and you sold 3 of them when it hits this 1.5 level move, then you're left with 1. You sold 3, you had 4, so that's you sold 75% of them. You're left with 1 as a remaining runner. So the 66.95 call price on the close of this candle here is 33.35. So at this point we have 1,095 profit per option on the at the monies. The slightly out of the money 67.05 call is 25.12 on the candle close. That's a $902 profit per option. The furthest out of the money, the 67.15, the price on candle close is $17, is now a $620 profit per option. Now a 2-level move on this indicator is considered the ideal minimum target move for a regular trade, whereas the 1.5 level move is the minimum level target move on a regular trade. That means when it hits R2, if we were trading from the bull bear KPL, because R2 is 2 levels above since this is a bullish trade. If it was a bearish trade and we were instead looking at the reverse situation and we were trading puts, then S2 would be a 2-level move on a bearish trade taken from this level. So at 10.54 on this candle here, it hits R2. So on a regular trade, that's the 2.0 minimum level ideal target move for a regular trade. And you would have the same decision to make here. 100% closeout, no matter how many contracts you have, or keep all your contracts, adjust stop loss to break even, or break even plus the 10 to 15% profit buffer, or if you have multiple contracts, close out, scale out 70 to 90% of them, adjust the stop loss to break even, or break even plus the profit buffer of 10 to 15% on runners. Now, if we were in a session where price continued to move up, today it did not do that. As you can see, as soon as it hit this, it started backing off. It tried it again, backed off, tried it again, finally broke above and closed above. However, today's session, it did not move up to the next midpoint or the next main level. If we were in a session, as you'll see in some of the other videos we've made recently where we did get further moves, as it continues to move up each level, if you are adjusting your stop loss on remaining runners or adjusting your stop loss in general, then you would add more and more profit buffer if you were not closing out. So on each level that it keeps moving up, here you'd have another decision to make. Do I close out all the remaining contracts, or do I further adjust the stop loss by adding a additional profit buffer? When it hits this, I do the same thing. Same decision. Do I close out all remaining contracts, or do I add more profit buffer? In this case, we didn't see that today. We saw it retrace from this level, try again, retrace, went up, finally broke above it, went back to it again, basically ended up here about the same as almost what the high was in this session. So in this particular session, that did not come into play as far as making any further adjustments, because we did not get to this level or this level. Alright, so on the 10:54 a.m. candle, it hits R2, the 66.95 at the money call. On the close of this candle, 44.40, that's now a $2,200 profit per option. The 67.05 out of the money options, 34.60 on the close of this candle, that's an $1,850 profit per option. The furthest out of the money, 67.15 on the close of this candle, is 25.90. That's a $1,510 profit per option. Okay, so at this point what we're going to do is we're going to pause the video. We're going to look at the Thinkorswim option charts that are going to be 2-minute charts for each one of these options, so you can take a look at that. Alright, so the first one we're going to look at is the at the money option. Of course, if you remember, this is the standard play. Here is the 9:30. We're on a 2-minute chart for the options as well, same as our chart. And here you can see the close of this 9:30 a.m. candle, 22.40. Here would be your one level move scalp when it hits the R1 level, 26.80. Here's the 10:26 a.m. candle, the 1.5 level minimum required move for a regular trade, 33.35. Here's the 10:54 a.m. candle for the ideal minimum two level move, and it is 44.40. Next, we'll take a look at the 67.05. Here we have the 67.05 call option chart. Here's the 9:30 candle close here, $16.10. Here is where it hits R1 at 9:46 for a scalp only, $19.18. Here is the 10:26 a.m. candle where it hits mid R1, R2. That's our 1.5 level minimum required move for a regular trade, 25.12. Here is the 10:54 a.m. candle where it hits R2 for our ideal 2-level minimum move, and it is $34.60. Now, next we'll take a look at the furthest out of the money one that we could have considered, which is the 67.15. Here's the 67.15, 9:30 a.m. candle close, $10.80. Here is the 9:46 hit of R1, close $13.10, so that's for a scalp only. Here is the 10:26 a.m. where it hits the 1.5 level minimum required move for a regular trade, $17 on that candle close. And here is the 10:54 a.m. candle for a minimum ideal level 2.0 level move, $25.90. Alright, now we'll go back to the regular chart. Alright, so one thing I do want to mention is that if you are interested in purchasing this indicator, the price of this indicator will be going up soon. This will be the last week that the indicator is at the current regular price that it is at. And you can request a discount promo code by sending an email to daytradinggps@gmail.com, and you can request a discount promo code to purchase this indicator, and in return for the time that you've taken today of your valuable time to watch this video. So if you send us an email at daytradinggps@gmail.com, we will send you a discount promo code that's good for a substantial discount off of the current regular price that we sell it at. As I said, that price will be going up next week, and so this is your opportunity to not only get it at the current price but also get a significant discount off of the current price by requesting that promo code. All of our indicators are sold on a one payment for lifetime access basis, so you make one payment and then you have the indicator for lifetime access. That also will give you updates to the indicators, so if we come out with an update, which we are planning on coming out with another update to this indicator in the near future with some further enhancements, you will be able, all those that already own the indicator are grandfathered in, and they will be able to get the any updates with any further enhancements at no additional charge. As I mentioned before, there are several other videos that you can watch on different topics about this indicator. You'll find them in the description of this video, and we hope you've enjoyed this video, and if you have, if you would please like the video and subscribe to our channel, as that helps us out with the YouTube algorithm. So thank you for taking your time today to watch this video, and we invite you to watch other videos on our channel, and we wish you much prosperity in all of your future trading endeavors.